So I wanted to dive into it because 230 million, okay, that's the fund size. Why did you decide 230 million was the right amount to raise?
Yeah, a couple of different, it was all about portfolio construction. I ran a lot of math in order to figure out, using historical venture data, I ran Monte Carlo simulations for optimal portfolio construction for a solo GP. And
what does that look like then? Help me understand. How many companies, like how much for initial, how much for reserve?
Yeah, so it's about 12 to 15 portfolio companies. You have significant concentration, so you probably have like 40 to 50% of the fund in the top 3 holdings, maybe more. And so it's an unusual portfolio construction. The analysis that there's basically, there's a couple of different, the Monte Carlo simulation spits out a couple of different dominant strategies, and this is one of them. And this is the one that aligned with when we talked at the beginning about the way that I like to invest, about being thesis-driven and really understanding the space. If you go deep into a space and you can understand it, then ideally you're in a place where you have a lot of conviction and you can keep investing and keep supporting a company. And I also think in a venture environment that's going to be significantly different this 10 years over the last 10 years, setting up a venture firm to be able to consistently invest behind its companies should provide founders a bit more comfort from their financial partner.
So I similarly did the math on Monte Carlos, and I found that at 23 companies, you get something like 82 to 84% of the benefits of diversification. And so what you're saying is essentially with deep theses and deep thinking and a lot of time, you need less diversification because your ability to pick is significantly better, correct?
That's exactly right. That's the
totally get it. So we're doing Series A's, I've taken, like, what's the check size per company estimate?
Yeah, it's about 8 to 12 initially.
Okay, 8 to 12 initially. Blunt question, is the fund big enough given how large like AI machine learning rounds are today, being 30 to 50 million on a pre-seed or a seed, as we're seeing quite often now?
We can flex. We're not in a position to be able to lead a $50 million Series A. We could co-lead. So that's one way of doing it. And if you're raising a $50 million Series A, you probably do want it from 2 different VCs. But we've got a lot of flexibility, and that was by design. So because we're so concentrated, we can focus our resources where we have the most conviction.
Can I ask, how do you think about the decision on doubling down? You said there are about kind of 3 companies could be, say, 50% of the capital base. What does that conviction building process look like to putting that much capital behind one of the 3?
Yeah, I think it's a lot of diligence. I mean, we'll spend 6, 9, 12 months researching a space. Like, one of the themes that we have is the decade of data. So I've been investing in lots of different data companies for a long time, have a pretty strong network there. So one component is just really understanding the market, understanding the buyer base, the different segments, their needs. Another component is benchmarking companies. So I've been doing that for more than 10 years. I've got a pretty significant database of data points there. So just understanding on a relative basis, what is the ultimate performance. A third part is understanding what the exit markets look like and the entry prices, and what is a reasonable multiple expectation over what period of time.
There's the exit market analysis. I go back and forth on, is it worth doing because it's so variable? You could look back on the prior 24 months and say, well, it could be that, or it could be today, or it could be way, way worse. We can't project out 7, 10, 12 years. Is it valid doing it?
I think it is because, so the historical forward multiple is about 5x, let's just say, right? It's a little higher than that, it's about 5.5. And in the heyday of quantitative easing, the top quartile companies are trading at 40 times. And so you can't go, and today it's about maybe 6. And so you can't go into a company today and say, okay, I'm going to project a 20 times forward multiple on this company at the time of IPO if it's at 100 million growing at 70%. You just can't. That's I would say that's irresponsible because it's just completely unrealistic. And if you've spent the majority of your time in venture during a time when you've had those kinds of multiples, you need a check on what do you think your return expectations are going to be, given that, whatever it is, a 4% ESOP, employee stock option pool dilution by year, and the dilution created by other venture rounds and that. And so going through that discipline, I think, is as much just like particularly for working in a team or It's just a really important discipline step. The other thing that I really love to do is there's this awesome book called Super Forecasters that a guy named Ted Lowe wrote. And he talked about Enrico Fermi, who created the atomic bomb, or was one of the team for the Manhattan Project. And Fermi had this way of thinking, which was all about conditional probabilities. It's called Fermization. The idea is like, just enumerate the conditional probabilities. In order for this generative AI company to succeed, the first thing it needs to do is hire a PhD team. Okay, what are the odds I think they can do that? Then they need to raise a Series A. Okay, what is the base rate for raising a Series A from seed is about 60%. Then they need to raise a Series B. Base rate's 50%. Then they need to do this and this and this. And you put it all together and then you tie it to your expected value and you kind of come out with a big range of what you think the ultimate outcome can be. And each company is going to be different. A marketplace has to do supplier acquisition, supply side acquisition, and demand side acquisition. And so like that framework, at least for me, really helps me to think about what are the 2 or 3 key issues or questions that a company needs to answer over its lifetime. How do those odds change? And ideally they improve, and the more that they improve, the more comfortable one ought to be in concentrating.